You're scrolling through real estate listings at 11 p.m., and every single house that doesn't look like it was condemned in a previous life is asking $400,000. The kitchen has countertops that were last updated when flip phones were cool. The carpet is that shade of beige that whispers, "We gave up." There's a half-finished basement that the listing agent is calling a bonus space. And somehow the price tag says $400,000. Meanwhile, you're sitting there doing mental math on your paycheck, wondering if you missed a memo or if the entire housing market has just collectively lost its mind. Spoiler alert, it's not you, it's the math. And the math is not your friend right now. My name is Cash, and today we're going to do something that real estate agents absolutely hate. We're going to calculate who can actually afford a $400,000 house in 2026. Not who the bank will approve, not who technically qualifies on paper, who can actually afford it without turning their entire life into a financial stress test that never ends. Because there is a massive difference between getting approved for a mortgage and being able to sleep at night after you sign the paperwork. If that distinction matters to you, and it should, make sure you hit that subscribe button and give this video a thumbs up. My name is Cash, and I spend way too much time thinking about housing math, hidden costs, and the financial traps the system never warns you about. If you're someone who wants to make smart money decisions before they become expensive regrets, you're in the right place. Let's start with the uncomfortable reality. In a growing number of US markets right now, $400,000 is not a luxury price. That's not getting you a mansion with a pool and a 3-car garage. In cities like Nashville, Charlotte, Phoenix, or anything within reasonable commuting distance of a major metro, $400,000 is what the market calls a normal house. A 1,400 square foot box, 3 bedrooms, 2 bathrooms, a yard that fits 1 lawn chair comfortably, if you angle it right. The median household income in America sits around $84,000 a year. So we're asking people making $84,000 to afford homes that cost nearly 5 times their annual income. If that ratio makes you uncomfortable, good, you're reading the situation correctly. But everyone keeps saying you can do it. The mortgage broker says you're pre-approved. Your parents bought a house on way less. Some guy on social media is talking about no money down strategies like it's still 2005. So what's the actual problem? The problem is that everyone is lying to you about what the word affordable actually means. Let's start at the beginning, the down payment, because this is where most people's homeownership dreams quietly fall apart before they even get started. The traditional rule is 20% down. On a $400,000 house, that's $80,000 cash. Let me say that number out loud again. $80,000. The median savings account balance in America is around $8,000. So you're not a little short. You're not almost there. You are $72,000 short of the starting line. And before you say you'll just save it, let's run that math too. If you're making $84,000 a year and managing to save 10% of your gross income, which almost nobody actually does consistently, you're putting away $8,000 per year. At that rate, it takes you nearly 9.5 years to save the down payment. And that's assuming home prices stay exactly where they are right now, which they will not. There's actually, let me put it this way, you're not just saving for a moving target, you're sprinting after a moving target that has a head start and better shoes. Okay, so you skip the 20% down, you put down 5% or 10% instead, which is what most buyers actually do. Congratulations, you just unlocked a brand new monthly expense called PMI, private mortgage insurance. This is the fee you pay every month for the financial crime of not being wealthy enough to put 20% down up front. It's a poverty tax built directly into your mortgage statement. Now here's something the reference videos don't always tell you. PMI costs are not one size fits all. Your FICO score plays a massive role. If you have an 800 plus credit score and put 15% down, your PMI might run as low as $35 to $40 a month. But if your score is average and you're putting down 5%, you're looking at $90 to $150 per month on a $400K loan. And if you go FHA, the monthly insurance factor jumps significantly. We're talking $150 to $200 plus. The bottom line is the same, regardless of which end of that range you land on. You are paying extra money every single month for insurance that protects the bank, not you, because they're nervous you might default. You're already starting from financial punishment before you've even unpacked a single box. Now let's talk about the actual mortgage payment. You put down 10%, which is $40,000 that you somehow scraped together over years of disciplined saving. That leaves you with a $360,000 loan. At current interest rates, somewhere in the 6.5% range. Depending on your credit profile, your monthly mortgage payment lands around $2,200. That is principal and interest only. That number does not include a single other thing you need to actually live inside the house. Here's the thing most people miss. The mortgage payment is just the opening bid. Let's add property taxes. Depending on where you live, you're looking at anywhere from $3,500 to $7,000 per year. Let's use a conservative $400 per month and keep it reasonable. Then there's homeowners insurance. Premiums have climbed sharply in recent years in most markets. You're looking at $150 to $280 per month, depending on your location, your coverage level, and whether you're in a zone that insurers are currently trying to quietly exit. Then there's maintenance, the expense that every first-time buyer dramatically underestimates until the water heater dies at 9 p.m. on a Friday. The rule of thumb is 1% of your home's value per year. On a $400,000 house, that's $4,000 annually, roughly $333 per month, set aside just to keep the house from falling apart. And don't forget that PMI we discussed. Add another $90 to $150 depending on your score. And down payment. Let's add this up. Mortgage payment, $2,350. Property taxes, $400. Insurance, $200. Maintenance reserve, $333. PMI, $120. Your total monthly housing cost is sitting at roughly $3,403, and that's assuming nothing catastrophic happens. No roof replacement, no HVAC failure, no HOA assessment showing up in your mailbox like an uninvited house guest. And the crazy part is, financial advisors will tell you not to spend more than 28% of your gross monthly income on housing. Banks will approve you if your total debt-to-income ratio is under 43%. Let's reverse engineer both of those numbers. If you're spending $3,403 per month on housing, and that represents 28% of your income, you need to be earning roughly $145,800 per year. If we use the more lenient 43% rule that banks actually use to approve loans, you still need to be pulling in around $95,000 annually, and that's before we account for any other debt. Here's the kicker. Only about 20 to 25% of U.S. households earn $145,000 or more, which means somewhere between 75 and 80% of American households cannot comfortably afford a $400,000 house under any responsible financial guideline. This is not an opinion, this is arithmetic, doing what arithmetic does. But you're thinking people are still buying these houses, lines at open houses, bidding wars. Who are these people? Some of them have dual incomes in well-paying professions. Some of them received family money for the down payment. Some of them are stretching so thin that a single unexpected expense, a layoff, a medical bill, a transmission would put them in genuine crisis. Let me show you what that actually looks like when you run the numbers on a real household trying to make this work. Meet a household, let's call them the Garcias. 2 working professionals, combined income of $130,000 a year. That puts them solidly above the median, upper middle class by most definitions. They should be comfortable, right? Let's watch what happens when they buy that $400,000 house. Their gross income of $130,000 sounds solid until the IRS, state taxes, FICA, and a modest 401k contribution show up to the party. After all of that, they're taking home approximately $7,800 per month. That is their actual real money to work with. Subtract that $3,403 9-month year contrast off. They're left with $4,397 for everything else in their lives. 2 cars. Because suburban life doesn't have a subway, there goes $650 in payments. Car insurance for both vehicles, $220. Gas because nothing is walkable, $250. Student loans, because those degrees were required to get the jobs that qualified them for the mortgage, $500. Health insurance premiums, their employers don't fully cover, $350. We are now at $347 remaining. Think about that, $347 for clothing, entertainment, kids' activities, if they have them, car repairs, medical copays, the occasional dinner out that reminds you that you still exist as a person and not just a mortgage payment. And savings, emergency fund, additional retirement contributions beyond that modest 401k, we haven't even gotten there. This household is spending 44% of their take-home pay on housing, not 28%, not even 35%. Nearly half their entire income goes to the house before they buy a single gallon of milk. And these are not reckless people. They are not buying jet skis. They are not taking European vacations. They are simply trying to live in a house that the market told them was attainable. Here's what that actually feels like, day to day. It feels like checking your bank balance before filling up the gas tank. It feels like saying no to a $40 kids activity because that money might be needed if something breaks. It feels like lying awake at 1 a.m. doing math in your head about whether the tires can last another month or if you have to deal with it now. It feels like being permanently one unexpected expense away from a genuine financial emergency. The furnace goes, that's $4,000 you don't have. Someone rear-ends you, and your deductible is $1,000. You're putting it on a credit card, the roof starts leaking, you're financing a repair on a house you technically own. This is the reality for a household earning $130,000, trying to carry a $400,000 home. Now imagine what it looks like for the household making $100,000. Or, God forbid, anything below that. At median income, buying a $400,000 house isn't tight, it isn't stretching, it is a mathematical impossibility, without either significant outside help or a level of financial risk that would make a skydiver reconsider. Real talk, what percentage of your take-home pay are you currently spending on housing? Drop it in the comments. I'm genuinely curious how many people are living this math right now. But here's what makes this truly insidious. The housing market does not care about any of these numbers. Sellers list homes at $400,000 because that's what comparable homes sold for last quarter. Banks approve buyers at 43% debt to income because technically the loan probably won't default immediately. Real estate agents encourage buyers to stretch because their commission is a percentage of the sale price. Nobody in that transaction has a financial incentive to tell you that you're about to financially drown yourself. The system is engineered to get you into the house, not to ensure that you can actually afford to live in it. And once you're in, once you've signed the papers and moved the furniture and posted the photos, you're not really free to walk away. You can't decide 6 months later that this was a mistake, without destroying your credit score, losing your down payment, and potentially owing more than the house is worth if the market dips. So people stay. They stay in homes they cannot comfortably afford. They work jobs they hate because they cannot risk any income disruption whatsoever. They watch their savings evaporate month after month. They wonder why they feel so exhausted and stressed when they're supposedly living the American dream. Here's something nobody puts in the mortgage brochure. Over a 30-year loan at 6.5% on $360,000, you will pay approximately $820,000 total to own a house you bought for $400,000. That's $460,000 in interest alone. You paid for the house twice and then some. The bank made more money on your house than you paid for the house. Think about it this way. You are not just buying a home. You are signing a contract that says the bank gets first claim on roughly $23,000 of your earnings every year for 3 decades. Let me tell you what the harsh truth sounds like. For somewhere between 70 and 80% of American households, a $400,000 home is not genuinely affordable, not sustainably, not without accepting a level of financial fragility that would have been considered reckless a generation ago. This is not about personal failure. This is not about not working hard enough or not being smart enough with money. This is about a housing market that has completely disconnected from income reality. Home prices have increased roughly 400% since 1990. Median household income up about 180% in the same period. The math doesn't work. It cannot work. And yet we keep acting like it does. We keep telling people that homeownership is the foundation of wealth building, which is technically true, while ignoring the part where you have to survive the mortgage first. We keep repeating the myth that if you just budget more carefully, cut back on unnecessary spending and hustle on the side, you can make it happen. But here's what nobody wants to say out loud. You cannot budget your way out of a structural affordability problem. You cannot side hustle your way to a down payment when rent is already consuming 40% of your income. You cannot positive think your way to a lower interest rate. What you can do is understand the actual numbers, so you can make a real decision based on reality rather than pressure. Maybe that decision is to keep renting and invest the difference aggressively. Maybe it means looking at a $250,000 house in a different market, even if it means some lifestyle adjustments. Maybe it means acknowledging that homeownership in your current city is simply not the right move right now. And that is completely fine. Because here's what nobody tells you. There is no prize for buying a house you cannot afford. There is no trophy for being house poor. The pride you felt the day you got the keys fades. The stress of making that payment every single month does not. And here's the really twisted part of all of this. Because housing has become so unaffordable over the past decade, we've normalized the misery. We've rebranded financial desperation as just part of adult life. Oh, you can't afford furniture for 2 of your rooms. That's just part of the journey. Skipping dinner out for 6 months straight because everything went to the mortgage? You're building equity. It's like we've collectively agreed to pretend that drowning slowly in housing costs is a rite of passage rather than a symptom of a genuinely broken system. The math is telling you the truth. Culture keeps whispering that you should buy anyway. Your parents bought a house at your age. Never mind that their house cost 3 times their annual income, and yours costs 5 times yours. Your friends are buying. Never mind that you have zero visibility into their actual financial situation, or whether they're quietly in crisis behind that freshly painted front door. Society tells you renting is throwing money away. Never mind that being crushed by a mortgage you cannot afford is also throwing money away, just with extra steps and significantly worse consequences. So let me give you permission to do something that feels radical, but is actually just rational. You can look at a $400,000 house, run the honest numbers, and decide it is not worth sacrificing your financial stability, your mental bandwidth, and your ability to build actual wealth. You can keep renting. You can save with real intention and wait for a better entry point. You can look at smaller markets or more modest price points. You can acknowledge that the version of the American dream being sold right now has been distorted into something that serves the financial industry far more than it serves you. And that is not failure, that is clarity. Because here's what actually builds wealth. It is not owning a house you can barely afford. It is having margin in your budget. It is being able to invest consistently without choosing between the stock market and the light bill. It is not having to decide between fixing the roof and contributing to your retirement account. It is sleeping without anxiety about next month's mortgage. Real wealth is financial freedom, not equity. You cannot touch because you are trapped by the very asset that's supposed to be making you wealthy. The financial industry has spent decades convincing people that buying is always better than renting, that you should stretch as far as the bank will let you, that homes always appreciate, so the risk is worth it. But they're selling a product. The bank profits from your 30-year mortgage, the agent profits from the sale price, the insurance company profits from your annual premium. Nobody in that chain of transactions makes money when you say, actually, this doesn't work for me. So if you're sitting there right now feeling priced out, feeling like homeownership is becoming an impossible milestone, feeling like you're somehow failing at being a functioning adult, I need you to hear this clearly. You are not failing. The system is not working for you. Home prices have outpaced wage growth so dramatically that what was a normal middle-class milestone for previous generations has become a luxury item for most people today. A $400,000 house is not a starter home. It is not automatically affordable because a mortgage broker approved you for the loan. It is not something you should stretch for unless your income can genuinely support it without financial gymnastics. Run your real numbers. Include every cost, not just the mortgage payment, but taxes, insurance, maintenance, PMI, and the 10 things that break in the first 2 years. Be honest about your income stability and your actual savings. And if the math doesn't work, walk away without shame. There is no honor in buying a house that makes you miserable for 30 years. The real win is making decisions grounded in reality rather than social pressure, based on math rather than emotion, based on your actual financial situation rather than the one you wish you had. That is how you avoid becoming a cautionary tale about what a $400,000 house really costs. Look, I'm not telling you to abandon home ownership forever. I'm telling you to stop treating bank approval as the same thing as personal affordability. Those are two completely different calculations with two completely different consequences. Maybe in a few years, your income grows significantly. Maybe the market adjusts, and that same house is $320,000. Maybe you move to a city where $400,000 actually buys you something that makes sense for your life. But right now, with current prices, current rates, and current wages, this math is broken for most people. And pretending it isn't doesn't make you an optimist. It makes you a future data point in someone else's video about the foreclosure wave. So here's the actual advice. Stop looking at what you qualify for and start looking at what you can genuinely afford without turning your life into a permanent financial tightrope act. Find the number where you can pay the mortgage, handle repairs, save for emergencies, invest for the future, and still remember what it feels like to not be stressed about money every single day. For most people, that number is not $400,000. And that is completely okay. You are not less successful because you are being honest. You are not failing at adulthood because you refuse to financially bury yourself for quartz countertops and a 2-car garage. You're just doing math that apparently most people in this industry would rather you didn't do. The market will keep pretending these prices make sense. Banks will keep approving loans that stretch buyers past their limits. Agents will keep telling you it's always a great time to buy. But you don't have to participate in collective financial delusion just because it's become the norm. Sometimes the smartest move is recognizing when the game is rigged and choosing not to play. If this changed how you think about the real cost of homeownership, pass it along to someone who's about to sign papers without running these numbers first.